Hello everyone and welcome back. In this video we will talk about MSCI because the company just reported earnings for the fourth quarter of 2025 and the stock is up plus 5%, plus 6%. So what is happening for MSCI? Why is the stock going up? Is this a buying opportunity? Is this a selling opportunity? Here is the plan for this video. I want to show you the earnings report and I have some comments to make. I want to show you the slides, okay, the latest slides, and also I have some comments to make. Also, we will go through my own Google Sheet and I have some comments to make, some adjustments we have to make to really understand what is happening with MSCI and why is the stock up 5%. And also together we will listen to the earnings call. I have the earnings call here. We will listen to the transcript and I have some comments to say. Because I can spoil you right away, I am not a fan of this report. This report was okay, nothing dramatic, nothing extraordinary. So why is the stock up 5%? Maybe they said something very positive, very bullish on the call. And I did not listen to the call yet. I don't want to spoil myself. So I want to start with the analysis of the numbers, right? What the company is doing, the operations. And then we'll look at the call because maybe they said something very powerful during the call. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And full disclosure, I am a shareholder of MSCI. This is roughly 10-11% of my portfolio. So obviously I am biased, I am positive on the company, but I don't want to only show you the positive. Okay, and I can start right away by showing you some negative aspects about this report. I can start with the earnings report, as you can see here, and this is it. You have the numbers. The operating revenue is going up 10%, organic revenue up 10%, nothing really challenging here. Here is the first negative point I found for this report. In red, this is negative. In green, this is positive, in my opinion. In red, recurring subscription revenue up 7.5%. People that are not following MSCI will skip this line. Actually, I've seen no one on Twitter or YouTube talking about this. But if you go through the track record of the company, Wall Street analysts wanted this line to go up a lot. And what is great is you can backtest this. You can check the track record of the company. If you go to Fiscal AI, you click on Financials, you click on this line, percentage change, segment KPIs, this line, recurring subscriptions, organic revenue. You can see that on a quarterly basis, we are at 7.5. This is what they said. In the past, the company, the stock price went down because the metric was bad. In December 2024, and then for the most part of 2025, people were not too upbeat about this 7% growth rate, 8% growth rate. We wanted this growth rate, this recurring subscription growth rate, to go up. And in 2025, it went up from 7.5, 7.7, 7.9, 7.9, and now going back down. It is bad. We want this metric to go up more than 8%. I expected more than 8%. So first, disappointing point from this video. I will not tell you all the positives in this video. I want to tell you all the positives, all the negatives. You will have a clear, I hope, unbiased opinion, even though I'm a shareholder. In the past, this metric was growing more than 10% per year. As you can see here, 2020, 2021, 2022, 2023, and now we are at 7%. This is quite bad. We want this ratio to go up again, okay? Maybe they will shock the world and go back to more than 10% in the future, but first line of the report, not good. After this, you have a green highlight here, asset-based fees up 20%. This is where MSCI has the most amount of margins and cash flows. The markets are going up. You have a lot of inflows, so they are making much more money in their index segment. In case you don't know MSCI, and this is one of the first videos you're watching, let me do a quick description of the business. Roughly 50% of the business is linked to index, so AUM, benchmarks, if you compare yourself to the MSCI World, custom indices, okay, very high margin, and this is half of the business. 25% of the business is analytics. So for fund managers, they want data, risk allocation about their own portfolio, so for professionals. And the remaining 25%, this is ESG. So what is your ESG profile for all the stocks you have in your portfolio? Scope 1, Scope 2, Scope 3, governance, etc., etc., etc. And a little bit of private asset. Okay, a private asset segment that is negligible. Okay, so the big segment is indices. After this, analytics. After this, ESG. And after this, a small segment that's private assets. The most important segment is index. So this line, asset-based fees up 20%, is significant. And this is maybe the reason why the business is growing 10% per year. You will see a lot of growth here. Don't worry, in this video I will show you all the segments, all the growth rates, all the margins. I mean, this is the only video you need to watch, okay? Next point, you have operating margins of 56%, which is really good. I will show you the different costs of the margin profile here for the business here. Don't worry, I will show you all the lines. And after this, you have this line, diluted EPS down, adjusted EPS up. Something is strange here. I'm putting it in yellow here. The diluted EPS is down, the earnings per share are down, but the adjusted earnings per share are up. You have an adjustment to make here. Don't worry, I have made the adjustment for you, so you just have to enjoy the show. But something is off here. And then what do you have? New recurring subscription sales up, etc. Nothing really outstanding here. The company did some buybacks during the quarter. In fact, this is a big buyback quarter for them. And then they paid dividends and they increased the dividend payment. Okay, fair enough. I will not analyze this small income statement because I want to give you more details. You can just note that year on year, the operating margins comparatively to last year, operating margins went from 54% to 56%. So they increased in profitability. And the adjusted EBITDA margin went from 61% to 62%. I'm not a fan of adjusted EBITDA. I'm just mentioning it in case you want it, but I will not focus on this metric. What do they say? In the fourth quarter, MSCI delivered strong results while achieving a number of key milestones, including our 11th straight year of double-digit adjusted EPS growth. Let me just add a quick comment here, and I've seen no one on YouTube mentioning this. The incentives of the management team. How is the CEO compensated? What is his bonus? The bonus of the CEO is linked to several metrics. If the revenue is growing, Henry Fernandez gets a big bonus. If the adjusted EPS is growing, the CEO gets a huge bonus. The CEO is paid not in function in relation to the earnings per share. The CEO is incentivized to boost the adjusted EPS. You have small adjustments between EPS and adjusted EPS, but I suppose this is why they are very proud to say we are growing the adjusted EPS every year double digits. The CEO will get a big bonus at the end of the year. Okay? A record asset-based fee run rate driven by record inflows into ETF products linked to our indices, which is very good, and our best ever quarter for recurring sales in index. This is significant. This line is very significant. MSCI's deep-rooted competitive advantages have helped us build momentum across product lines and client segments. With emerging client segments in particular, we are doubling down on key opportunities while reinforcing our role as the essential intelligence layer of global investing. Well, this is what they have to say about AI. As a result, MSCI is well positioned to benefit from AI and use it to increase the value of our solutions, Fernandez added. MSCI is considered to be a software company, so when all the SaaS companies are going down, MSCI is following. The same thing is true for MasterCard, for example, or Visa, also going down partially because of AI and software companies. MasterCard has the value-added segments anyway. With these analytics segments, they have software. And a worry Wall Street had in the past was, will MSCI be disrupted by AI? If AI is available for anyone, maybe people can create their own custom index, okay, their own benchmark. So maybe you don't need MSCI to have an index. Maybe you don't need to pay MSCI thousands of dollars in fees to have your own index. Well, MSCI is defending itself and they say we have proprietary data, we have the reputation, we are stable, and actually AI will improve our business model because AI can accelerate revenue and AI can reduce costs. And we will talk about this later in this video about if this is true, if AI is really accelerating revenue to create more products, and if AI is reducing costs. Because if AI can really reduce costs, we are talking about a business model that is already very profitable. The margins can continue to go up. So maybe the business will be immensely profitable in the future. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Okay, so let's see line by line what do they have to say here. For the revenue, nothing to say. Revenue is up 10% per year. Nothing really changing. Run rate and retention rate. The run rate is up 13%. Recurring subscription run rate increased, and organic recurring subscription run rate was 7.7%. The retention run rate was fine compared to 93% last year. I can show you the chart of the retention rate to show you that it is not a big deal actually. The business is fine. Index, all of the company retention run rate. This is the retention rate of the company. People will argue that the retention rate is down, but you have to compare year on year, right? Now the retention rate is 93.4%. Last year it was 93.1%. So it's always stable, increasing a tiny bit, but roughly stable. Don't blindly compare quarter over quarter. This is a mistake to do this, okay? Next point. Expenses. The expenses are up 6%. I want to talk more about this. And the headcount. 2% increase, which means they are not hiring anymore. It's a trend that we have seen for the last quarter of MSCI. In the last quarter of MSCI, I made a 3-hour long video about it. You can check it on my YouTube channel. It's public and it's free. You had a revenue that was growing double digits and they are not hiring anymore. The number of employees was up 2%, which means you are growing your business without additional cost. And it seems like the trend continues. In the last quarter, like this quarter today, they increased the number of employees by 2.2% year on year. So the trend is continuing. You can grow 10% per year, but the headcount is up only 2% per year. So margins are going up. And then I want to talk about this later. This is a first adjustment you have to make. Fair enough. Let me scroll down a little bit. Let me talk about the segments, and after this we'll talk about the slides. First, as I told you, the biggest segment is the index segment. In 2025, the plan for the management team was very simple. We want to grow the index segment, and be careful guys, if we grow and we become more aggressive with our index segment, margins will go down. This was what the management said last year. So let's see if they delivered during this quarter. If you check the growth rate, you have recurring subscription of 8% growth rate, asset-based fees up 20%, which means the index segment is growing revenue at 14%. You have expenses of 8%, which means the margins are going up. The index segment is the most profitable segment. It is growing 14% per year, and the margins went up from 77% to 78%. This is enormous actually. And some people will say it's good, they are becoming more profitable and growing more. And some people it's bad because literally the management said expect lower margins. and they have better margins. So it is better than expected, but the management maybe is doing something different. I can show you the evolution of these margins over time, so you really understand my point. I created a custom metric on Fiscal AI to show you the index adjusted EBITDA margin. I know that this metric, adjusted EBITDA, is not good. I know it. This is what Charlie Munger said, the bullshit earnings. But this is the best kind of profitability measure we have. We don't have operating income, we don't have net profits, we don't have free cash flow margin. So this is the best metric we have to track profitability. And if you check the profitability for this index segment, we are at an all-time high. The margins are at 78%, all-time high for this business. Even on a quarterly basis, annual basis, you can check on all the basis, all-time high. The best metric we had, what was 76%, and now we just reached 78%. Yeah, all-time highs. So the segment is growing 14%, and it is being more profitable. I can show you the growth rate over time of this segment. During 2021, when you had a lot of inflows, when markets went up immensely, in 2021, everything went up. The revenue of this segment was up like 25%. And then you had the crash of the market, a bear market in 2022, flat. And now it seems like we are growing double digits. So the index segment, I want to talk about the first segment, is in a safe zone. Everything is going up and the margins are going up. Nothing to say here. Now I want to talk about the second segment, the analytics segment. This is how you can gauge your risk metrics if you are a portfolio manager. What did the management said 1 year ago? And what are they doing now? 1 year ago, they said, we don't expect to grow massively, but we want to focus on efficiency and margins. Let's check. If you look at the growth rate for this segment, growth rate is 5.5%. So this is bad, but this is in line with what the management said. They said we want to focus on margins. Let's check if they focus on margins. The answer is they went from an adjusted EBITDA margin of 48% to 46%. So the answer is no. The answer is bad. Okay? I'm a shareholder, right? I don't want to show you all the positives. And if you look at the margin, we can do the exact same exercise for analytics. So first, let me show you the growth rate of this analytics segment. As you can see on a quarterly basis, this is your growth rate. To be frank, the growth rate of this segment was not immense. Before, even in 2021, this segment was growing 6% per year. And then in 2023, because of an acquisition, the revenue went up. If you remove the acquisition, the business was never growing a lot. They bought a business called Buybacks at the time, which improved the growth rate. If you adjust for the acquisition, we are talking about a segment that has always grown at single digits. So nothing surprising. This is normal, as expected, growth rate of 5%. If you look at the past 10 years, the analytics segment has always grown at 4%, 3%, 5%. Then you have a big spike because of an acquisition. So it's not organic growth, it's an acquisition. And we are back to 5%. So business as usual, but the margins changed. I can show you the margins over time. By the way, you see me navigate with Fiscal AI, creating custom metrics. I'm using Fiscal AI, and you can use Fiscal AI also. I have an affiliate link, a discount code in my description. You can try this website completely for free for 2 weeks, and then it will get cheaper, 15% cheaper if you use my link. So yeah, use my link. It's you can use this website for free, and this is the only website I know where you can create your own custom metrics, as I can show you here, the profitability per segment. So it's one of the best investing websites you have, and I'm using this website on a daily basis. So if you want to do it for yourself, click on my link in the description. For the analytics profitability, in the past, you had adjusted EBITDA margin of 30%, and then 35%, and then 40%, and it is at a high plateau, I would say. This is what you have. fluctuating, but the margin profile seems to have stabilized over here. I mean, they guided for an improvement of profitability. It is not happening. Bad. Let me move on to the next segment. The ESG segment. In ESG, what did they say last year? They said exactly the same thing as analytics. We don't want to grow a lot, but we want to squeeze the margin profile. We want to have a lot of profitability and be efficient. Okay, so the revenue growth rate was 6%, which is good, I mean, as expected. And the adjusted EBITDA margin went from 35% to 42%. So yes, very good. The margin profile improved. Oh, no, not red. Green. The margin profile is good. They literally delivered. I can show you on Fiscal AI the same trend. First of all, I will show you the growth rate of the ESG segment. You will see that in the past, especially in Europe, the ESG segment was growing 50% per year. And then the growth rate decelerated because ESG turned out to be a fad when it comes to asset management. Okay. And the growth rate went from 50% to 30% to 20% to now 8%. And now they are growing single digits, 6%. But it was to be expected. The management literally told us investors what was going to happen. And the focus here was on profitability. Let's see if they delivered. If you look at the ESG segment, sustainability segment, margins went from 35% to 42%. Margins are at an all-time high. The management executed wonderfully. You have a clear positive trend when it comes to margins. In the future, I expect the margins to be sky high for this segment. They improved the margins by 7 percentage points in 1 year. What if they continue to improve? The margin profile will go to 45, 47, 49, 50%. It is possible. So very good execution from the management team on the ESG part. Also, the last segment, private assets. This is a smaller segment. They said the same thing. We want to grow a little bit, but we want to focus on margins. So let's see what they have. They grew by 8%, which is decent. And the margin profile decreased. They went from 23% margins to 22% margins. Let's do the same exercise. Don't worry, I will accelerate my analysis when we look at the slides. KPIs, all over. This is your growth rate. Good luck analyzing this one. This small segment is filled with acquisitions, so the growth rate will move a lot. Good luck having an opinion on this chart. This is the revenue growth rate. Well, they grew by 8% year on year. And what about the margins? I told you this is a segment that is less important than the other ones. If you look at the margin profile, this is what you have. Sustained profitability of 20-25% adjusted EBITDA margin. So they are not executing good. They said they would want to focus on efficiency and margins. It is not happening. So this one is bad. Okay. Then what do I have on the report? Do I have to change to slides? They talk about their cash balance, what they have. They have a lot of cash in the balance sheet, and they recently took on more debt. Now the total debt to adjusted EBITDA ratio is 3.3, which is in the range of 3 and 3.5. So I don't expect an additional debt increase in the future. And they say they recently took on more debt, etc., etc. The operating cash flows increased by 16%, and they did a buyback program. Actually, last quarter, the company did the biggest buyback program ever. They bought back a big amount of shares. And now they did it again. They repurchased a lot of shares during this quarter. You can see here the different moments the company accelerated buybacks. In 2018, in 2022, 2023, and in the Q3 2025, they did a buyback program of $1.2 billion. And now they did a buyback program of $900 million. You can compare this with the free cash flow or even the operating cash flows that the company generates. You can see here that the blue line is really large right now. The blue chart is big for 2 quarters in a row. Actually, the company generated $400 million of operating cash flows, and they used triple the amount to do buybacks. So literally, the management team is telling everybody, we think we are cheap. We are using all our operating cash flows to do buybacks. Even more than this, we are using more than all our cash flows, double the amount, triple the amount, to repurchase as many shares as possible. Add to this, the CEO buying shares for his own account and his own family, I think at 2 instances in 2025. You have the biggest buyback program ever. The CEO is buying. The CEO is telling investors publicly, I think we are undervalued. People underestimate us. And they repurchased 5% of their shares. I can show you on Fiscal AI the percentage change of shares. You click on diluted weighted average. Here is what you have. In 2016, they started a buyback program that was huge when the company was cheap. So better like this. As you can see here, this is the buyback program. How many shares were repurchased over the past decade? You see that in 2019, the buyback program was huge. They repurchased up to 7% of their shares. And then in 2022, it was big, 4% of their shares. And now it is even bigger, 5%. So you don't have a lot of times, a lot of moments in history where the company pounces on buybacks. And all the moment the company did a big buyback program, it was because the company was cheap and it was a good buying opportunity. And now the company is doing a massive buyback program. This is the largest buyback yield we have in 5 years, 6 years, let's say 5 years. Since COVID. So it tells you a lot about what the management thinks. They think they are cheap right now. Dividends, they continue to increase the dividend. MSCI is a small dividend payer. Anyway, this is their guidance for 2026. Actually, I was a little bit disappointed by their guidance. Nothing really exemplary, nothing really shocking, this is why I say I don't understand why the stock is up 5% today. Now the market's closed, but the stock started the day being flat, and I could understand if the stock was down actually. And it went up and up and up and up. So maybe they said something on the call, because so far I am not impressed. For the segments, some of them decreased margins. For the index segment, they delivered more. And for the guidance, it's nothing shocking. So I don't understand why the stock is up 5% today. In terms of operating expenses, operating revenue, effective tax rate, nothing changing. They expect to grow high single digits or roughly 10% per year. It's not as if they delivered a spectacular guidance, an acceleration of the revenue. No, nothing really changing. They expect the free cash flow to grow between 5 and 10% per year, and they expect capex to grow. The capex line for next year is expected to be $160 million to $170 million. Now I want to make a point here, because Fiscal AI is wrong. Now I got your attention. If you look at this line, the capex line, and if you compare the capex line of Fiscal AI, you will not find the same results. Look at it. This is your capex line over time. What can I say? Annual. On Fiscal AI, if you click on the line called capital expenditures, so the capex, you will see that for the past 20 years, it has been oscillating between $25 million, $40 million, $20 million, $40 million. And the company is guiding for what? $160 million? You have to raise your eyebrows if this is happening. I mean, you have to ask questions. What is really happening here? And actually, the capex line on on Fiscal AI is only talking about tangible assets. But there is another way to increase your capex, intangible assets. What is great is, if you know how to use Fiscal AI, you can see that there is another line, purchase of intangible assets. You click on this line, here is the orange line. In other words, that's your tangible capex in blue, new buildings, facilities, and software capex in orange. What you see here is, as the world moved to be a digital era, especially since COVID, the orange line accelerated. So people that don't know how to use Fiscal AI will look at the blue line and say, the capex is fine. I mean, the capex is very, very low. But actually, the real capex of the company is the sum of the orange line and the blue line. And you see that the orange line is quite high and growing. They created their new platform called the MSCI One in 2022. So in 2022, everything accelerated for the orange line. If you do the sum of these two lines, you have 90 and 40, so that's 100, you can see here, $130 million, which makes more sense, right? Now the guidance for 2026 is to have a capex of $160 million or $170 million. So they expect more capex. What do they mean they expect more capex? Didn't they say that AI will increase costs and reduce costs? I mean, maybe you need to reduce capex, reduce the costs. So that doesn't make any sense. Maybe they are speaking like Meta platforms or other tech companies. Maybe, this is what they say on the call. I don't know what they say on the call. Maybe they say, yes, we are investing in-house, but this is temporary. Maybe in 2027, the capex will slow down once we have implemented AI. Maybe you don't have this infinite increase in capex. Maybe. So we will track what they say on the call, but it seems to me like the capex line is higher than expected. So free cash flow guidance is reasonable, growing single digits, but the capex line is growing a lot. What is happening over there? And actually, by the way, if you are using Fiscal AI, you can create your own custom metric. Custom metric here. You do the sum of these two lines, and I created it, the capex, to include the intangibles also. It will help you for other businesses. Here is a quick tip for you watching this video to thank you for watching my content. So you can create your own custom metric to have the entire capex and not fall into this trap of believing the capex is only $40 million. So you see that everything accelerated for capex in 2022 because in 2022 they had this new strategy of having an integrated platform. You have a little bit of index, a little bit of analytics, a little bit of ESG, and you do everything in one super app, super ecosystem, so you can cross-sell your customers, upsell, cross-sell, and it works. Because, I mean, you have the data on this. It works. So far, you have an improvement in capex, but it is working because customers are staying more. Stickiness, upselling, etc., etc. I'm surprised by the guidance of capex, actually. And I don't know why the stock is up. I mean, only this guidance item would maybe crash the stock price. I could have totally understood if the stock price was down minus 5% because of this big capex line. How can you say AI will become more efficient to you and decrease cost, and at the same time you have a big capex increase for the guidance? Let me scroll down. I don't think I have anything to say more on the report. Maybe this is for later. Let me keep it this. Now I want to go about the slides. I want to take my time for this video. I hope you are enjoying the time with me here. For the slides, a couple of points, a couple of comments. If you look at the first slide, they talk about their numbers, free cash flow, etc. You look at the earnings per share, that is down. Why is it down? Why are the earnings down? But the adjusted EPS growth rate of 11%, so they are very proud. And then you scroll down and you see this chart. One of the most important slides when it comes to MSCI. Every quarter, all the investors and Wall Street and all the analysts of the world are monitoring this slide. what is the net new recurring sales you have per region. Depending on the quarter, sometimes the Americas, this line will be positive, and Europe negative and Asia negative. Sometimes all three of these regions will be negative. Sometimes all of them are positive. Depending on the positivity, negativity of these three lines, the stock is going up a lot or going down a lot on earnings report. Maybe one of the reasons why the stock is up today is because these three geographies are up. Americas plus 12%, Europe plus 13%, Asia Pacific plus 50%. This is very good news and I love to see it. This is not the first time it happens, but it's always good to see all your regions having incremental new sales. Let me scroll down. They talk about their different metrics. We already talked about the growth rate of each segment. They talk about their private assets. I checked already, this is irrelevant for your analysis. This is not important for MSCI. And then they talk about something quite important. The index segment. We said in the past that this index segment was growing 14% per year and they became more profitable with better margins. And I wanted to know why. So they have a slide, index segment, asset-based fees details. The asset-based fees revenue went up 21%. Okay? And this is the quarter end AUM by market exposure. You see that the emerging markets part was up 40%. The countries outside the US saw massive inflows, plus 40%. My guess is MSCI makes more money if they manage more AUM, asset under management. If you have a lot of inflows, for example, I've seen some articles saying that you have outflows from the US and inflows in Europe. You have a lot of inflows towards the European companies or emerging markets. If you have more inflows of money, MSCI manages a better pool of capital and they get a royalty fee of the amount that is being managed. So if you have a lot of inflows, they are more profitable. At the same time, you have another way of making money is what is your royalty fee? This is this line, the period end basis point fee. They have a royalty fee for all the assets they manage of 2%, 2.43%, 41% here. This line is stable. Another way they can make money is if the markets are going up. And this is my point. And this is what I put in red because I don't like. The index segment was very profitable because of several reasons. Yes, you have more inflows, as you can see here. Inflows of capital, people invested more in the US, developed markets ex the US, and emerging markets. But also, a big part of the growth was because of markets change. Meaning, markets are going up. If you have an AUM of $1 billion and the markets are up 20%, your new AUM is $1.2 billion. So you take a royalty fee out of the amounts that are being managed. If markets are going up, you manage more capital, so you have more royalties. MSCI generated a lot of growth because markets went up. If markets are going down, MSCI will become less profitable. And this is not something that I like particularly because this is very volatile. Maybe in 2026 we will have a crash and then all the earnings will go down. So I don't like when people say MSCI is resilient because look at the growth rate of 14%. I mean, you are almost cheating. It is not because of you. It is because markets are going up. If markets were stable, you would not have this 10% growth rate or 14% growth rate. You would have half of this, okay? Market change. So yeah, I put this in red because I think that's a little bit too much. In 2025, markets went only up. So yeah, a little bit too much. As you can see here, for geographic exposures, almost the same. For geographic exposures, for the AUM, US, you have an increase of $15 million. Developed markets, you have $100 million. Emerging markets, $70 million, which means the cash inflows were $200 million. Okay? This is one argument why the revenue is up. Another argument why the revenue is up is markets change. It's not $200 million, it's $400 million. So 2/3 of the increase in AUM for some regions are because that markets went up. It's not because the business model is resilient, very efficient, high quality. No, it's because markets went up. And as you can see here, the AUM line of the company, this is the growth rate of AUM, 36% in 2025. And maybe this is a little bit too much. And if you have a recession in 2026, if you have a bear market in 2026, maybe people will get disappointed. I don't want my viewers to expect this line to continue. This is my point. I hope that's very clear to you. We don't care about this chart. The options, we don't care. That's irrelevant to the thesis. After this is not important. They talk about their buybacks. They did a lot of buyback. Their second biggest buyback program ever in one quarter. And they have a strong balance sheet. They don't have to repay their debt until 2029, which is true. If you look at the maturities of their debt, they don't have to repay their debt in 2026. They don't have to repay their debt in 2027. They don't have to repay their debt in 2028. The only moment when they have to start repaying the debt is in 2029. So, I mean, take as much debt as you want. Now we live in a world with inflation, so you have a lot of flexibility. This is why they are taking more debt. And they are doing more dividends. They increase their dividend payments and they are doing more buybacks. This is their largest buyback program in a fiscal year since 2019. That tells you a lot about what the management thinks about their stock price. This is their guidance. And after this, I think we are almost done. I have a few charts to explain. And that will be it. You have the year-on-year recurring subscription run rate growth as reported and organic. Okay? For the overall business. In blue, you have the subscription run rate growth as reported. It went from 7% to 8% to 9%, 8%, 9%. I said, is this a rebound? I'm not sure. Now, it will be very important to monitor this line for 2026. Maybe in 2026, you will watch my videos and my future updates. Maybe not. If you are not watching my videos in the future, monitor this blue line. You want this blue line to go up. You don't want a fake rebound and a deceleration again. We want this line, this blue line, to be at 9% and 10%. If this goes above 10%, the stock will skyrocket. This is my prediction. So yes, you want to focus all your attention to this blue line. Same thing for the green line, organic subscription growth rate, stable, 7, 8%. Seems like the business is not dead. In the past few quarters, Wall Street was not very happy about this deceleration. It seems like the deceleration has stopped. And maybe this is the rebound. Quarterly retention rate, nothing really happening here. About index, this is what I say. In index, you have your asset-based fees run rate growth of 26% because markets are going up. I think they are cheating a little bit now because the markets are only going up a little bit too much. So be careful about what you see. But it seems like the deceleration has stopped. Look at the green line. The growth rate for subscription run rate went from 13%, 12%, 11%, 9%, and dead stable at 9%. So it seems like the business is resilient for their subscription business model. Analytics, nothing to see here. Sustainable, not much of an impact. It's stable. Wall Street will like the trend reversal for the blue line. Not that the green line is still dropping. This is normal. The business is not focused on ESG growth. Yeah, nothing really to see here for the ESG segment. And for the private assets, I will not mention it. Let me scroll down. Are we done? Should we go into the figures, the financials now? The adjustments? We are done. So I can close this. And this one, I'm keeping it for later. Okay, if you like this format, please leave a like, subscribe, comment. It's always helpful to the YouTube channel if I receive a lot of like and subscriptions and comments, it's always good for the algorithm. Okay, let me zoom in a little bit so you see better. And let me drink a little bit because I've been talking for a while now. I have created a Google Sheet with the income statement. And the goal of the exercise is to see what moves what. What moves revenue, what moves margins, what moves earnings per share. Why is earnings per share going down while the adjusted earnings per share is going up? What is happening? So, very good. I did the work for you, so you don't have to. If you look at the top line, you have operating revenues going up 10.6%, which is pretty decent. Nothing really changing here. The business is growing revenue 11%, 11%. The cost of revenues is going up 9%. You start to see an asset-light business model. I said asset-light business model here. Your revenue is going up 10%, your cost of goods sold going up 9%, so the gross margins are going up a little bit from 82.3% to 82.6%, a slight improvement of gross margins. But still, we are talking about a very profitable business model with gross margins of 82%. Now let's go down the list of costs. The selling and marketing cost. I expect this line to be high, and actually I expected this line to be much higher because in 2025 the management said we will push for our custom index. For the index segment, expect lower margins because we will push more into marketing, so we will have more cost when it comes to marketing. Guess what? The selling and marketing line is only up by 8%. Okay. I would have loved to see better growth here, but anyway, this is a cost. The research and development line is up 7%, which is maybe an indication of AI implementation. You don't need as many employees in R&D to implement AI. This is actually a good line to see. And then something really interesting. General and administrative costs went down. It went down. So this is what I say here. You have an employee count that went up 2.2%. 2.2% more employees. You can check what was the trend in the past. Last quarter, in Q3 2025, the employee count was 2.2% increase. In second quarter, 2.5%. In first quarter, 5.6%. And then in 2024, it was 6%. So we knew it from the conferences last year that they don't want to hire anymore. So this line is dead stable. You don't have any increase in costs for general and administrative costs because they don't hire anymore, which is lovely to see. This is something they said in the past and now they are doing it. Good. Amortization of intangibles. This is stable. Quite strange, but I don't know how to analyze this one. Capex, not capex, something to monitor in the future, but not now. And depreciation is irrelevant. We are talking about a small number here, $3 million change. Anyway, the total operating expenses went up 6%. So revenue is up by 10%. Cost of revenue is up by 9%, so lower than the revenue. And the operating expenses are up by 6%. You have a delta between revenue and costs. So that means operational leverage. That means the operating income is not growing 10% per year. The operating income is up by 14.4%, which is lovely. I mean, this is great. So the core business is here. And margins, operating margins, went up from 54% to 56%. You now understand all the lines of the income statement, all the reasons why the profitability, the overall profitability of the business model is improving. They are stopping the hiring process. The revenue is up more than the overall cost. And seems like it is working wonderfully. You have operational leverage. These are the core operations of the business. And now it will become negative. Now things will change in tone because they recently issued more debt and you have to pay this interest on the debt. So you have interest income that is irrelevant. We are talking about peanuts here. And you have this big line, interest expense, that went from $45 million per quarter to $63 million per quarter. That's an increase of 40% of all the interest you have to pay for the debt. So yes, the company is wonderful because they took more debt to do more buybacks and reward shareholders because the stock was cheap. But you have a cost. You have to pay the price. So this is your cost of debt. This is not good when it comes to margins, but to be expected. They literally announced it. So yes, they are paying more interest on their debt. And also you have this new line, other expense, that went from zero, this line was zero, to $15 million of cost. What is that? That's including 12 million loss resulting from the full write-off of the investment in a minority investee. I did some due diligence here and did not find a lot of things. So let's assume it will be here. Maybe you want to adjust it, but it's a one-off event. If you have more interest to pay, at the same time you have a one-off event, that's a lot of cost, which means the pre-tax margins went from 48.8% to 47.2%. The margins decreased. The income before taxes is up by 7%. Not good. More cost of debt, a one-off event, not good. Before I make all this adjustment in red, I will continue the income statement. And after this, I will make the adjustments to see if we didn't have the one-off event, what are the real margins. Okay, let's continue down the line. You have margins, taxes that went from $57 million to $100 million. Let me repeat. They increased their taxes by 80%. What do I say here? They lose their margin improvement because of the cost of debt. And the tax rate for this company went from 16% tax rate to 26% tax rate. And I have seen 0 people on the internet mentioning this. On Twitter, YouTube, anyway. You have a much higher tax rate. They have a guidance for 2026. A guidance tax rate of 18 to 20%. What is happening? Why do you have a tax rate that jumped by 10 points? Much higher tax rate. Okay, I did the research for you, so you don't have to. And let's see what I have here. So, this adjustment reflects discrete income tax expense recognized in connection with the multi-phase internal legal entity restructuring that commenced in the last quarter of 2025 and was completed in early January 2026. In Q4 2025, the company recognized discrete tax expense of $40 million to the first phase and expects to recognize a discrete tax benefit of $90 million in 2026. In case you don't understand, it's normal. This is an asset management business. There are several moving parts at the same time, but basically, the company is reshuffling, changing its internal legal structure. You are moving assets, moving internal property, subsidiaries between different entities, and different entities will lead to different taxes. So to be more efficient, they are moving things, moving the furniture inside the house. And because you are moving things, sometimes you have to pay taxes when you move something out of a room. Okay? So the bad news is for this quarter, they had to pay $38 million upfront as a toll charge, like more tax cost for starting this move. But in 2026, because of how they move things, they expect to save $88 million in taxes later this year. So on a net basis, this is fine. When I say net result, they are currently coming out ahead by about $50 million in gain, but the timing is split around 2 different years. You can check, by the way, on Fiscal AI, the amount of taxes that the company paid. You go down here, provision for income tax. You can see that the line went up. Boom, you have a big jump for this quarter. Yeah, big jump of $30 million, $40 million because of this change in entity. But we said on a net basis, this is a gain for them of $50 million. $50 million is almost the equivalent of taxes they pay in 1 quarter. So actually, this change in tax regime subsidies is very good for MSCI for 2026. The tax rate will not be 26% for all year long, guys. It will only be this quarter, and then the tax rate will be between 18%, 20%. But yeah, for some reason, you have to pay the price, and they decided to make this change in this quarter, 4th quarter of 2025. This is the reason why the tax rate is so immense. And this is the reason why the net income is not positive. You have to pay a lot of taxes, so the net income is down 7%. As we said previously, they repurchased 4.7% of their shares. This is their second biggest buyback ever, which means net income down 7%, but you do 5% buybacks, so it offsets a little bit, and the earnings per share is down 2%. You now understand what they mean. You now understand this line. Diluted EPS down 2%, but adjusted EPS up 11%. Which begs the question, what is the adjusted EPS? What is the adjusted earnings per share? And they show you here. Exactly. Boom. You have a line in the appendix at the end of the report that nobody really looks at. Well, this is why I'm here, right? How they calculated the diluted EPS. Okay? And then they make all the adjustments. You have an adjustment, tax impact on internal legal entity restructuring, and then loss on investment in investee. If you put the small footnotes of 2, this is where you have the information. 38 million tax expense you have to pay now, and then an 88 million tax benefit you will have in the future. And for the loss on investment in investee, I did not find a lot of things, actually. I would have loved to see an additional footnote information here. This is not good, but I think this is one-off. So now, what are all the adjustments you want to make to really understand this business model? If you didn't have this one-off expense because of an investment, and you put the same number here as we had last year, then if you only change this, the revenue growth rate is the same, operating margins is the same, the income before taxes would have grown at 11% per year. So even if you adjust this small number, the impact of the cost of debt, the new cost of debt, I will not adjust the cost of debt, by the way, guys. The business decided to have more debt, they have to pay the price. So now they have to pay more interest. The cost of debt has this impact. Operating income growth went from 14% to pre-tax of 11%, a 3% impact. We went from 14% to 11%. Despite this, the pre-tax margins are up, okay? Slightly up. So on a pure core operations business, the pre-tax margins are up. What is the second adjustment you want to make? What if they didn't have this extraordinary 38 million tax expense? Okay, let's remove $38 million from this line. So 104 minus 38 million. Yes, you have a tax rate that is much more reasonable. So the real tax rate, in case they didn't do this one-off changes, the real tax rate is 16.38%. A small increase compared to last year, by the way. So they have to pay a little bit more taxes. Anyway, if you have these two adjustments, the net income would have grown at 10-11% per year, similarly to the revenue, by the way. And the company did a buyback program of 5%. So the earnings per share are growing 15-16% per year. The real core operations of the business conclude this. The real business is growing at this rate. Revenue going up 10%, operating income plus 14%, income pre-tax 11% because of the cost of debt, but then the net income is going up by 10%, you do a little bit of buybacks, so the earnings per share are going up 15-16% per year. This is what is really happening. But as always, we have moving parts. You have more tax rate, you have interest, you have one-off changes because of change in entity, anyway, investee. Well, if you adjust for a normalized tax rate, the business is fine. The business is growing earnings per share at 16% per year. This is good. I mean, I bought MSCI because of this. This is a business that can grow revenue by 10% per year, improve the margins by 1 or 2% per year every year, and they do a little bit of buybacks every year. So I bought MSCI because of this. They can grow earnings per share by roughly 15% per year for a very, very long period of time. And actually, the growth rate will accelerate because of AI. So now you know what are all the moving parts. I will add some commentaries on this one. Yes, okay. I'm thinking if I'm forgetting something here. I chose the EPS. I don't think so. Okay, fair enough. So, a couple of comments from this report, and after this, we will listen to the earnings call together. They focus on their crown jewel. The business focuses on its crown jewel, the index segment. It is growing a lot, and it is very profitable. The margins are going up. Second point I want to mention is they are lucky the markets are going up and AUM is going up. I told you before, for some segments, 2/3 of the growth is because markets went up. If the global indices of the world were stable, have been stable, you would not have the same growth rate, okay? And if you had the stable markets, maybe the revenues would have gone up by, 8%, 9%, which is less good. So, what did they say and what did they do? The index segment improved the margins. It is not as planned, so I'm putting a red cross, but we like it. The analytics segment decreased margins. Red cross, not good. The ESG segment improved margins. Very good, as planned. And the private assets segment decreased margins. Not good, that's bad. So, it's a mixed quarter. This is why I don't understand why the stock is up 5-6%. I just don't get it. The business was having some positive news and some negative news. It was okay. In the future, margins will continue to trend higher. I'm almost sure of what I say here. They will just improve efficiency everywhere and the operating margins will go up. I'm talking about operating margins. The cost of debt is impacting the overall profitability. Oh, sorry. I don't know how to write. Impacting overall profitability. As you saw here, the cost of debt is reducing the margin by 3%. Okay, and it will continue like this. You had a one tax issue. I expected the stock because of this to drop because of this, like we had for Meta Platforms a few weeks ago. If you remember, it was the last quarter, so 3 months ago, 4 months ago, Meta Platforms had a huge tax impact. They had to pay a huge tax expense, and people looked at the earnings per share that was trending down, margins going down, and they panicked, and people panic sold. I expected, while seeing this for MSCI, I expected the market participants to not like this report, because officially, on a GAAP basis, the earnings per share are down 2%. And because people don't do the work, I expected the stock to be down because of this, to be honest. Now, for 2026, they can cheat and manipulate the tax line for 2026 in case they miss analyst estimates. This is also a point I've never heard anyone talk about. This is the kind of value you can get on my channel. Subscribe. So now I think they timed this entity thing the right way. Meaning, in 2025, markets went up. They knew they were going to beat estimates, revenue and earnings per share. So they decided it was a good moment to make their move in terms of changing the tax efficiency of the business. You say, okay, we know we are beating the estimates. Let's do this now because we're in a comfortable position. So now in the future for 2026, in case some elements are slowing down, we can have a little bit of manipulating data. Now we said they had $88 million of tax benefits. They can allocate these tax benefits whenever they want. If the next quarter, Q1 2026, is bad, guess what? They can play around with taxes and they can reduce their taxes for this quarter that is bad. So they can save face a little bit and improve the earnings per share. So this is why I say they can cheat and manipulate the data a little bit. They have more leeway to arrange their numbers the way they want, which is bullish for 2026, to be honest. Now they have paid all the expenses. Now we can just have the benefits. I don't expect major acquisitions in the future. The capital allocation is clear. The capital allocation decisions are extremely clear for MSCI, and this is also the reason why I am invested in MSCI and not other companies that are similar. So they want to do buybacks in a big way, and I love this. Now, I said the guidance is weak. I told you before, the free cash flow is expected to grow single digits, and the capex is expected to grow double digits. So I'm not a fan of the guidance actually. More capex is expected. Is the capex going to grow more, or is just a one-off increase to implement AI? I expected a stock price drop of 3 to 5%, to be honest. The quarter was okay, nothing dramatic, nothing great. And the earnings per share is bad because of taxes. So because of this mixed quarter and then a bad earnings per share, I expected the stock to be down. I think the market is too optimistic on this report. Or maybe the management said something bullish on the call. This is why I don't understand why the stock is up. For some videos, I say the market is underestimating the business. For this quarter, today, I'm doing maybe the market is too bullish. I don't think it's warranted. I would not be surprised if the stock drops back to where it was in a few days, because the report was decent. Or maybe they say something very, very bullish on the call, which is a good segue to the next part of the video. I told you, this is the only video you need to watch to really understand what is happening. Leave a like, comment, subscribe, do what you have to do. Okay, so normally everything is set up good. I have the mic here. You can listen to the call and we can start. I'm putting 1.25 speed because that's too low. The call is, oh boy, 1 hour and 20 minutes long. So yeah, let's accelerate a little bit. And I will put some breaks, some pauses, and add some comments. By the way, I'm using Fiscal AI to listen to the earnings call. Fiscal AI is the ultimate one platform investing website you can have. Use Fiscal AI. Use the discount code in the description.
Thank you, and good day, and welcome to the MS.
Okay, let's start. By the way, I want to make everything in one video because now you have seen what are all the moving parts. You have seen the adjustments. You have understood the margins. So now you can judge whether management is honest or not. This is the only way to do it. Can we turn the call? Thank you.
We encourage you to ask more questions by adding yourselves back to the queue.
I don't know if this is working.
With that, let me now turn the call over to Henry Fernandez.
Okay.
Henry?
Thank you, Jeremy. Good day, everyone, and thank you for joining us today. MSCI is generating impressive momentum across product lines and client segments. Our leadership in the global investment ecosystem and relentless focus on innovation has enabled us to drive a strong financial performance. In the fourth quarter, we achieved organic revenue growth of over 10%, adjusted EBITDA growth of over 13%, and adjusted EPS growth of almost 12% for the quarter and almost 14% for the full year. Our attractive all-weather franchise, client centricity, and alignment with favorable long-term secular trends have positioned us to deliver on the long-term growth targets we have set for MSCI. Since MSCI's IPO a little over 18 years ago, we have achieved a compound annual growth rate of nearly 13% for total revenue, nearly 15% for adjusted EBITDA, and over 16% for adjusted EPS.
Okay, funny they don't mention the real EPS, right? They only focus on adjusted EPS. Anyway, here are a few things I want to know from the call. One, AI. How will you implement AI? Are you so bullish on AI? What do you do with AI? What is this capex? Is this linked with AI or not AI? What is about AI? AI in the last quarter, they said would accelerate revenue, re-accelerate revenue, deliver more products, more services, reduce costs, improve margins. Any updates on this? Second point, we want to check the client segments when it comes to asset owners, asset management growth rate that was at 6% and oscillating at mid-single digits. Is this rebounding? 3, any comments on buybacks, obviously. Do you still think we are undervalued now that the stock has rebounded a little bit? Anything like this? And 4, what about inflows? We saw a lot of inflows for, how you say it? Emerging markets. Sorry, I'm just blanking on this one. Emerging markets. What is happening here? Any things you see for inflows of money? Any comment you have to say? And 5, about margins overall. ESG, picking up or not? Recurring subscription, growth rate, etc., etc. Here are a few things, but the most important part of the call, everybody knows it, you know it, I know it, it's AI. Will you be disrupted by AI? Because you have a lot of data. So how can you use your proprietary data to implement AI into your business model and monetize everything?
In addition, we have now delivered 11 consecutive years of double-digit adjusted EPS growth. We intend to continue with all these records at MSCI for the years and decades to come. In the fourth quarter and through yesterday, we also bought back nearly $958 million of MSCI shares at an average price of about $560 per share.
Wait. They say they did a lot of buybacks during the fourth quarter, and they say up to yesterday. So they are continuing to do buybacks in Q1 2026. What is priced in for their buybacks right now? On a quarterly basis, officially for Q4 2025, they repurchased how much of their shares? Seems like I have a bad Wi-Fi today. They bought back $906 million of shares. And they just said that they bought back $958 million of shares. So you have what? $52 million of shares already bought back in Q1. This is another way of saying we think we are undervalued. We still think we are undervalued. So yes, it answered one of my questions. Any comments on buybacks? Do you think you are undervalued? Yes, they're literally saying we continue the buybacks in Q1, $50 million. Average price of $560. Now the price is what? $615. Okay.
Over the last 2 years, we have repurchased almost $3.3 billion of our shares at an average price of $554. As you can see, we have a very strong conviction on the prospects and potential of MSCI, and we believe our franchise remains undervalued.
Good.
In Q4, MSCI's operating metrics included net new subscription sales of $65 million and non-recurring sales of $31 million, bringing total net sales to over $96 million. Q4 was, in fact, our second best quarter ever for recurring net new subscription sales, and we grew a growth rate of 18%. Across MSCI, our retention rate was over 94% for the full year. All of this resulted in total run rate of over $3.3 billion, growing 13%.
This is very good. This paragraph is extremely positive. This is very good. You grow more than 10% on a recurring basis with very high margins. This is extremely bullish.
And comprised of total ABF run rate of $852 million, growing 26%, and recurring subscription run rate of over $2.4 billion, growing over 9%. Q4 showed how MSCI is using our deep-rooted competitive advantages to drive growth. With newer client segments, in particular, we are doubling down on key opportunities while reinforcing our position as the essential intelligence layer of global investing.
Data.
So, for example, our index flywheel is helping clients form thematic baskets, gain global exposures, unlock new distribution channels, launch tradable products, and hedge exposures. In Q4, we delivered our best quarter ever for new recurring subscription sales in index.
This is good. And they called it before. They had different investing calls, conferences in April, May 2025. They called it before.
Meanwhile, total ETF and non-ETF AUM linked to MSCI indices reached approximately $7 trillion, driven by record inflows into our clients' ETF products linked to MSCI indices, particularly listed ETFs products in Europe. In general, asset-based fees remain a consistently strong contributor to our top line, with a durable track record of positive annual cash inflows into ETFs linked to MSCI indices every year, stretching back more than a decade. We also had a strong quarter in analytics, where we posted our second best Q4 on record for new subscription sales. In private capital solutions, we drove recurring sales growth of 86%, supported by our rollout of innovative new products and landing new client relationships.
Yeah, I'm not a fan of what they say about analytics. Margins went down. You don't care about the second best subscription sales. It was not what was expected, so I don't like this.
In sustainability and climate, our new subscription sales were lower than last year's levels, with particular softness in the Americas. In sustainability, MSCI is expanding our solutions across all client segments and asset classes to address emerging risks and opportunities that go beyond environmental, social, and governance matters. Examples include AI and supply chain disruptions on companies and fixed income instruments in people's portfolios. In climate, MSCI is emphasizing physical risk and energy transition tools that promote consistent standards and a common language across companies, industries, and
yeah, let me accelerate a
physical
little
risk
bit.
is just one area where we have been leveraging AI to enhance our capabilities with tools such as geospatial asset intelligence. We're also harnessing AI to enhance our solutions in custom indices.
They finally talk
risk
about AI.
insights, ESG controversies, and private assets.
How many times will they mention AI
For
during the
example,
call?
MSCI has decades worth of historical data on private markets, and we're now using AI to process this data in significantly larger volumes and then feed it into our total portfolio insights. Our company-wide total embrace of AI represents a technology-powered transformation that will increase the value of our tools for clients across the board.
Okay, now it's the time where the CEO will get very bullish. Last time, the last quarter, the CEO said AI was a godsend to MSCI. We will see if he can be even more bullish than this.
I will now review our Q4 performance among individual client segments. In general, MSCI is unlocking significant opportunities across high-growth client segments. With hedge funds, MSCI delivered 13% subscription run rate growth and 26% recurrent net new sales growth. One prominent deal in the quarter was the index rebalancing team at a top global hedge fund for MSCI's new extended custom index module, which spans almost 5,000 custom indices. This highlights the growing appeal of our index product ecosystem and the need for more tools from MSCI. Moving on to wealth managers, MSCI achieved nearly 11% subscription run rate growth, including 15% recurring sales growth, as we drive further adoption of our index and analytics tools among home offices and wealth platforms of large investment managers. For example, in Asia, we closed 2 major CIO office deals for our multi-asset class factor models, which helped make 2025 our best year ever in new recurring subscription sales in the wealth segment in APAC. Among asset owners, MSCI posted close to 11% subscription run rate growth, along our strongest recurring net new sales growth in 5 years, driven by private capital solutions and analytics. For example, we are seeing rising demand across regions from pension and sovereign wealth funds for our total portfolio solutions spanning public markets, multi-asset classes, and especially private markets as clients increase their private asset allocations. Shifting to banks and broker-dealers, MSCI delivered subscription run rate growth of over 9%, with large deals from index and analytics. The expansion of basket trading among banks has created new opportunities for us, given our capabilities in quantitative investment strategies and custom indexing. In Q4, this trend helped MSCI secure a landmark deal for our new basket builder solution with a prominent bank in the Americas. Using our tool, traders can rapidly create a standard and custom index baskets across client and internal workflows, with MSCI index content and IP forming a fundamental basis of these baskets. Turning finally to active asset managers, MSCI achieved recurring net new sales growth of 13%, primarily driven by index, along with subscription run rate growth of over 7%. Our Q4 results bode well for the gradual recovery of our performance with this important client segment.
This is big. This line is big. The asset managers segment is very important for MSCI and something that was very much covered by Wall Street analysts. And they said you had a growth rate of 7%. In the past quarters, we did not have 7%. It was actually decelerating. I can track for the third quarter of 25 what they said. They said the asset managers segment was growing 6%. Before this, Q2 2025, they said 6%. In Q1 2025, they said 5%. In Q4 2024, they said 5%. What I want to say is this segment was criticized on Wall Street because it was decelerating and only growing mid-single digits. But it turns out that over the past few quarters, this segment grew from 5%, 6%, higher than 6%, and now we are at 7%. So this segment is accelerating, and this segment is one of the most profitable segments for MSCI. This is key, and if this trend is bottoming, this is maybe a reason why the stock is up, because Wall Street is looking at this chart. Wall Street is looking at this growth rate for active asset managers, and the fact that it is now rebounding is very good news. And actually, they say we bought well. We expect a recovery overall in the future. What if it grows to 8%? This is very good growth driver for the future.
Active ETF products remain an exciting opportunity for active asset managers and for MSCI. In 2025 alone, MSCI supported our clients' launch of over 50 new fee-generating active ETF products in the market. As Q4 demonstrated, we are well positioned to benefit from AI, accelerate innovation, and drive adoption of new and existing products for established and emerging client segments, while still delivering compounded EPS growth for shareholders. And with that, let me turn things over to Andy.
Fair enough.
Andy?
Thanks, Henry, and hello, everyone.
CFO.
Great to see the strong momentum across the business. This momentum is supported by our pace of innovation that is fueling growth.
Oh my god, I put 1.5 speed because the CEO is speaking slowly, but I will have to put 1.25 speed for the CFO.
This momentum is
He's younger.
supported by our pace of innovation that is fueling growth across client segments and product.
Anyway, maybe that will be a little bit fast for you on YouTube, but it's okay. It's less important. You already know the numbers, so I will put it so we don't miss anything important, but it will be a little bit fast.
Areas. Index subscription run rate growth accelerated further to 9.4%, including 16% growth in custom indexes with some key wins among banks and hedge funds, as Henry highlighted. We also had success with asset managers, where index recurring subscription sales growth was nearly 10%, and index subscription run rate growth was slightly above 8%, reflecting the expanding usage of our content. Index retention remained strong at nearly 96% for the full year and 95% for the quarter. The acceleration in index subscription run rate growth was complemented by asset-based fee run rate growth of 26%. Equity ETFs linked to our indexes captured a record $67 billion of inflows during the quarter, totaling $204 billion for the full year. This growth is driven by extremely strong inflows into ETFs linked to MSCI developed markets ex-US indexes, including EFA and World, and MSCI Emerging Markets indexes, where we see large and rapidly expanding ecosystems being established around our indexes. We see extraordinary runway to fuel those franchises well into the future, and we are extending the ETF agreement with BlackRock through 2035 to solidify that tremendous future growth.
Sorry? Oh, this is great. MSCI is working with BlackRock, and you had some worries in the past that what if BlackRock wants to make their own benchmark, their equivalent? You had some companies like Vanguard that ditched MSCI in 2013. Let me show you. Vanguard, MSCI 2013. And MSCI was Vanguard was a big client for MSCI. So they lost a big client in 2013. Planned transition. So yeah, Vanguard told MSCI that they don't want to work with MSCI and pay the fees to MSCI, so they will make their own indices. And there is a worry among bears, people that don't like MSCI stock, saying that what if BlackRock stops working with MSCI? It turns out BlackRock will continue to work with MSCI, and they are extending their agreement until 2035. There is no plan to work separately, which is really good, and it removes a big risk because BlackRock is a big client for MSCI. It contributes to a big amount of revenue. So for the next 10 years, you will have BlackRock on your side. This is bullish. And I mean, the client concentration risk is just removed. Boom, disappeared based on this sentence. Another reason why the stock may be up. I mean, the call is pretty good for the moment.
To enable this growth, we will lower the fee floors impacting certain superscale ETFs on which we have been capturing a larger share of the overall economics.
By how much?
The aggregate impact will translate to be roughly 0.1 basis points based on year-end 2025 AUM levels, with roughly a 0.05 basis point decrease on January 1st of this year and another 0.05 basis point decrease on January 1st of next.
He mentions the fees. This is this line, in case that's not clear for you. Where is it? Do I have it? I have it. I've seen it. This line, the period end basis point fee. What is your royalty fee for all the assets you manage? You see that this fee is declining. They have negotiated to continue working with BlackRock, but you have to lower your fee by a little bit. 0.1 and 0.05. It's okay. Peanuts.
Year. Outside of the timing of these adjustments, we expect the fee dynamics to remain consistent with the trajectory we have seen before with respect to our overall ETF basis points. Our close partnership with clients like BlackRock and the shared success we've achieved together position us well to drive enormous upside. In analytics, we had subscription run rate growth of over 8%, driven by our second highest Q4 ever for recurring sales and higher retention. Recurring sales and analytics benefited from strong sales of our enterprise risk and performance tools, notably with banks and asset owners, in addition to continued momentum with our risk models. In sustainability and climate, one of our largest Q4 new subscription deals was with a large European wealth tech firm, positioning MSCI to be the embedded provider of sustainability solutions for small and medium-sized wealth managers in Europe, aided by our client's distribution network. This win drove a meaningful contribution to the product line's new recurring subscription sales in Q4. In private capital solutions, we saw growth accelerate on the back of closing almost $8 million in new recurring subscription sales in the quarter, an increase of 86% from the prior year. We've seen strong traction with our total plan offering and our transparency data, both of which have benefited from numerous enhancements and new capabilities.
By the way, you see me navigate with my mouse and highlighting the sentence because it will be easier for you guys to follow. If there is anyone working at Fiscal AI right now, can you implement the automatic highlight, please? I don't want to scroll with my mouse. I mean, I have to follow every sentence so my audience sees well, but please do it in-house. Or if there is any way to do it right now, please comment below this video, because I have to follow every sentences with my mouse like this. I would love it to be automatic.
In real assets, run rate growth was almost 6% with improving retention as well as sales of new solutions. Turning to our 2026 guidance, which we published earlier this morning, our expense outlook reflects the powerful operating leverage benefits of our business with continued investment initiatives fueling future top-line growth. I would highlight that capex reflects the anticipated build-out of a new London office space, as well as a...
Oh, okay. They did not mention this during the capex guide. They are building A new office space. Okay.
Increases in software capitalization related to key business investments across products.
Okay.
Our full-year tax rate guidance reflects an expected Q1 tax rate of 18 to 20%, which is higher than past years, as we will likely have a slight stock-based compensation headwind this quarter. Free cash flow guidance reflects the expectation of approximately $100 million of higher expected cash taxes in 2026 compared to 2025 due to various one-time discrete tax benefits in 2025 and the timing of cash tax payments between 25 and 26.
Yes.
Our capital position remains strong, with an ending cash balance of over $515 million at the end of December. Subsequently, we have paid down $125 million in our revolver, which now stands at $175 million. We will continue to pay down and draw the revolver in modest amounts from time to time to support our capital uses and optimize interest expense. In summary, MSCI's strong Q4 results are reflective of our mission-critical, durable solutions and our accelerating pace of innovation.
Yep.
We are seeing solid momentum in delivering new products, capabilities, and enhanced go-to-market efforts, and these are translating through to tangible results. We are focused on meeting client needs and enhancing value across client segments by delivering increasingly integrated solutions. As we've said in the past, the goal of MSCI is to have a fully integrated company in which each product line benefits from and contributes to every other product line.
Because of the MSCI One ecosystem super app they have created in 2022.
This will amplify the powerful compounding financial algorithm that has fueled our business, and we remain committed to delivering the firm-wide long-term targets of low double-digit revenue growth, excluding ABF, adjusted EBITDA expense growth of high single-digit to low double-digit, and adjusted EBITDA growth of low to mid-teens, enabled by the powerful operating leverage of our business. And we expect ABF to be an outsized double-digit grower through cycles and a key driver of the financial algorithm. However, we will no longer maintain product line-specific long-term targets to better reflect our focus on managing our investments across integrated product lines and delivering outsized growth across the company. Lastly, this change will not impact our current reporting, and we will continue to provide the same level of transparency and disclosure with continued reporting along product lines. As you can tell, we are very excited with the strong pipeline and opportunities in front of us, and we look forward to keeping you posted on our progress. Before we open the line for questions, I'll turn it back to Henry, who wants to take a moment to recognize Bear as he approaches retirement.
They will change the reporting. Unfirm long-term targets unchanged. They are changing the reporting for some of their segments. Okay, something to monitor in the future.
Thanks, Andy. I want to take this moment to recognize my business partner and friend of 26 years, Bear Pettit, who has played a critical role in turning MSCI into the standard setter we are today. Bear announced his retirement in November, and he will formally step down as president on March 1st. I know I speak for the entire senior leadership team at MSCI when I say that we will miss him tremendously. Looking ahead, I'm now excited to work with Alvise Munari and Jorge Mina, who many of our shareholders and the analysts that follow us already know very well, as we seek to build on MSCI's momentum and deepen our relationships with both newer and more established client segments. And with that, over to you, my very good friend and business partner of many decades, Bear Pettit. Bear?
Thank you, Henry, and greetings to you all. This is my final earnings call. As you may doubtless imagine, this is something of a difficult moment for me and one about which I have mixed emotions. Serving as MSCI's president and a member of our board of directors has been a tremendous honor and privilege that I could not have imagined when I joined the firm as head of EMEA coverage over 25 years ago. Not many people get the chance to impact the global investment ecosystem, and I'm grateful to have had the unique opportunity to help lead MSCI's growth and influence on the investment industry. As a long-term owner-operator, I was clearly delighted by the Q4 results, which show the resilience of that all-weather franchise, which we have spoken about on numerous occasions on this call.
Yes.
If there's one thing that has characterized MSCI in the quarter of a century that I've been here, it is the firm's constant ability to reinvent itself and to seek new opportunities in a variety of market and industry contexts. Many of those opportunities have proven to be extremely resilient and will remain a source of shareholder value for many decades ahead. The highly creative and client-focused teams at MSCI are wired to always keep looking for new opportunities and to drive client value and hence the growth of the firm. The evolution of MSCI into a truly multi-asset class provider of insight and actionable content for investors and other market participants has not happened overnight. The content and capabilities have grown both through organic investments and the variety of acquisitions with which you are familiar. The great power of the MSCI franchise is rooted in our talented people, who I know will continue to set new standards and drive innovation. It is also grounded in the value that our clients and shareholders derive from the growing number and variety of solutions MSCI deploys. I'm certain that as a shareholder, my retirement savings are in good hands, and that this great franchise will continue to create value for clients, shareholders, and employees for a long time to come. Thank you very much. And with that, operator, please open the line for questions.
Questions.
Certainly. And ladies and gentlemen, as a reminder, please limit yourself to one question. You may get back in the queue as time allows.
Blah, blah, blah,
Our
blah,
first
blah,
question for today. Our first question for today comes from the line of Tony Kaplan from Morgan Stanley. Your question, please.
Thanks so much, and Bear, really wish you all the best. Henry, I wanted to talk about AI. You talked about some of the launches that you made. Which do you think are going to be sort of the most meaningful for adoption in the near or medium term, however you want to frame it? Which clients are showing the most interest, and I guess what could this mean for your growth rate, both in maybe 26, but also even beyond that?
Very good.
Thank you, Tony. The journey with AI started 3-4 years ago for us, and initially has been extremely focused on creating AI agents to help us with the day-to-day operations of the company. We use AI extensively in applying to understanding controversies, for example, on ESG ratings. We've been using AI very, very deeply in the gathering of tremendous amount of data in the private market, in private assets, and the like. So those are two big examples, but there are about 120, 140 projects that cut across the company in using AI to augment the capacity of our smart and talented employees to leverage their smartness and capabilities. Then, halfway through it, we started focusing intensely on using AI for products. The first application of it was in our analytics business in terms of putting AI insights into the portfolios that are running in our servers for our clients.
Yes.
AI insights to understand the performance, the risk, the correlations. So in a way, it's like adding hundreds of people and people's eyes, in this case, digital people, of course, agents, to understand what's going on in the performance of our portfolios and the activities of our clients' portfolios. And therefore, that has taken off. We've had a lot of the embrace of what we call AI insights in the analytics product line. And so that's been a big benefit. Then we look at AI in terms of automating the custom index creation capability. As you know well, we've been working for a couple of years on designing a software application integrated with our production environment to create a large number of very fast custom indices and custom baskets, for trading, for investment products and the like. One of the things that we realized was a slowdown in that process is the human interaction of understanding the methodology, backtesting the methodology and all of that. So we've been training AI agents to do that process much faster than the humans, with obviously a lot of human supervision, right? So that is something that is already in place and it's already being rolled out as another example of that. So I think that most of our product lines will benefit enormously with AI agents in terms of either servicing the client or giving insight to the portfolio to our clients or being able to much faster create IP and the like. But I just wanted to highlight two examples on the efficiency side, in terms of controversies and data capture in private assets, and two examples on the product side. But I could give you 20 other examples in each category, but I just wanted to exemplify the enormous potential. The last thing that I will say is still early days in our application of AI across the board in MSCI. And we're extremely excited. The company is turning into a total AI machine, and we think it's a godsend to us, as I've said in the prior call.
Well, that's a bullish comment. Turning itself into an AI machine. If you turn yourself into an AI machine, the number of employees will never go up. In fact, the number of employees can go down if you automate everything with AI. You just need the human supervision, but why do you need more employees in R&D or general administrative stuff if you can integrate everything with AI? Quite bullish statement to say you want to be an AI machine. It's very early. They say they've been accelerating the AI investments for 1 or 2 years. What if they succeed? If they succeed, the margins will go sky high. Well, we will monitor it.
Our next question comes from the line of Alex Grant from UBS. Your question, please.
Hey, good morning, everyone. Wanted to come back to a topic I think I asked about a couple of times last year, which was this whole idea of international flows picking up and flows moving away from the U.S. I think we've started to really observe this in the marketplace now.
Yes.
I heard there was a recent asset management conference in Europe where the sentiment was better than it's been in years. So seems like there's excitement growing in your customer base. So wondering if this is actually starting to drive new sales, better conversations, and maybe most importantly, is it giving you better opportunities for maybe pricing a little bit more aggressively?
This is good. By the way, MSCI was criticized in the past because of increasing their prices without increasing the value of their software, of their service. So this is why they are talking about resiliency, adaptability, being more efficient, because they want this pricing power to be back. So let's see if they plan to increase prices. If they plan to increase prices in 2026, it will be very, very bullish for the company as a whole.
Thank you.
Thank you, Alex. All of the above, for sure. Now, we're a subscription business, as you know, so things don't take off immediately the same way that they don't go down immediately. So all of this stuff takes time. And of course, a lot of what we do is serve the long-term asset owners in the form of pension funds, sovereign wealth funds, endowments, foundations, family offices, and the like. And a lot of those parties don't turn their portfolios on a dime, right? They look at the secular trends, they take their time, and all of that. So obviously, as you know well, Alex, the immediate effect has been in the devaluation of the dollar. Obviously, the dollar has been out of favor, and people have been selling the dollar and selling dollar assets, as we know. And therefore, that has translated into significant flows into MSCI equity indexes that are ex-US, developed market ex-US. And likewise, we've seen the revival of emerging markets as well. I mean, we saw Korea hitting an all-time high for a couple of days this week, and the like. So we are definitely seeing the benefit of that, and we're seeing the benefit in the flows, the 200 plus $1 billion of flows into ETF linked to MSCI indices. The ETF of our clients linked to MSCI indices. That is a strong indication that people are putting their assets in non-dollar assets, right? Non-dollar securities. So that's another trend. On the subscription side, we for sure have seen a significant uptick in activity in Europe, in EMEA. Evaluating in one of our QBRs last week, we were very pleasantly pleased and surprised to some extent that our run rate in EMEA in index, including subscription and ABF, is higher now than the Americas. Which is an incredible feat, right, to achieve, given the nature of the capital markets in the United States. And that is on two fronts. One, the subscription, of our products in EMEA, plus obviously the huge inflow of assets into EMEA listed ETF. I mentioned that in my prepared remarks, that we have seen a significant increase in flows into ETF listed in Europe. So we're seeing that, and we had a very strong quarter in Asia Pacific. Obviously, in the fourth quarter, obviously sometimes it is the one quarter is very strong, the other quarter maybe a little weaker or softer. But I think that we have a very great franchise in APAC, and we're beginning to see significant activity inside APAC and away from the APAC investors going into dollar assets. So, but it's still very early days in all of this. The great rotation of assets, away from dollar assets and the U.S. is just at an early analysis. It is too early to tell whether that will continue on a secular basis or it's just cyclical for now, given the geopolitical aspects and the economic aspects. But we're well positioned either way.
They did not mention the potential price increases. They just said the business is in a good shape.
Thank you. And our next question comes from the line of Manav Panik from Barclays. Your question, please.
Hi, this is Brendan on for Manav. I just want to ask on the private assets, look like it has the best net new quarter, and it's been you've obviously been excited about the opportunity there, but it's been taking some time to for it to unfold. But I guess what drove that, and then is this the early innings of a trend, do you think, or is there some kind of one-time item, or what do you guys see there?
Sure. Yeah, thanks, Brendan. It's Andy. So yeah, it's been great to see the PCS run rate pick up. We also saw the real asset run rate growth pick up a bit. And we are seeing encouraging trends on a number of the key areas that we've been investing in and building out and enhancing over the last couple of years. Maybe just to give a couple areas of focus and areas where we've seen traction on the PCS side first. The strong sales were around areas like our total plan offering, which we've been really developing and proactively going to market around, as well as our transparency offerings. Both of those we've seen very good momentum on and a pickup in growth rates. We saw good growth not only in Americas, which, as you know, is a big part of the PCS franchise, but we saw actually tremendous success and traction in EMEA as well. That's been an area we've been intently focused on and building out our go-to-market effort, and we are starting to see some shoots there, which is encouraging. The outlook is positive. We believe this is a massive opportunity for us. We've got a very robust product development pipeline, and so we've mentioned some of these in the past, but we continually come to market with capabilities and content sets that really don't exist in the markets today, and we know there is strong demand for. So things like our recently launched document management and source view offering, we're seeing significant client interest around that, and positions us to do more for our clients. So continue to expand the value that we are bringing to them. And by the way, that's something that is enabled by AI as well. And AI has been a key enabler, not only on the data sourcing front, as Henry said, but also expanding the range of capabilities and insights we can give to clients. I would also highlight things like our asset and deal level metrics, things like our suite of indexes, including our private credit indexes, are all things that we're now in a position, I think, to drive that adoption and standardization. And so it is good to see the strong fourth quarter. We see attractive opportunities ahead of us. We see good momentum here and think we can continue to drive that. And we are also getting strong traction with a wide range of partners and distribution channels, such that our content and solutions are going to be increasingly accessible and easily usable across a wider range of the ecosystem. And that includes in areas like the wealth channel, which we believe is a big opportunity. On the real asset front, definitely some positive signs there. I think we've seen some green shoots in the industry. I think investment rose in the U.S. across nearly all commercial real estate sectors. There's some areas like office and retail where there was double-digit growth. And we've seen private capital moving from not only institutions, but we've seen private investment dollars coming back in as well. So it's all good signs, and we're seeing that translate through to some early movement. We still got a ways to go, but early movement with our index intel offering and traction with some of our new products like our data center product. So early days on that front, but definitely encouraging, but very exciting around the PCS opportunity.
Our next question comes from the line of Ashish Sabadra from RBC Capital Markets. Your question, please.
Thanks for taking my question. Andy, I wanted to ask you a question about the free cash flow puts and takes. You obviously called out the $100 million of cash taxes impacting free cash flow. I know you don't guide. So I was just wondering if you could talk about some other puts and takes like capex and interest expense and stuff like that. And I know you don't guide to adjusted net income EPS, but we all look at free cash flow as a proxy. So is the right way to think about it, like on top of free cash flow, add that cash tax and the share reduction in share count, and you should still get the low to mid-teens EPS growth in 26 in line with the long-term targets? Thanks.
What is that question? Of course. I mean, they are pretty straightforward with their guidance.
Yeah, so I'd highlight a few things in addition to the cash taxes, which was a meaningful item here. But we've got a couple sizable timing-related items that are depressing the free cash flow in 2026. But I would highlight that we are projecting strong double-digit collection growth with stable working capital dynamics. So the core fundamental underlying dynamics of the business remain quite healthy. In addition to the cash taxes, which, as I alluded to, is expected to be roughly $100 million higher than 2026. Part of that relates to some tax payment deferrals from 25 to 26, about 30 million of those, and roughly 50 million of one-time discrete benefits in 25.
And we already talked about this before in this video.
But on top of that, we also, as a reminder, had two debt issuances in the third and fourth quarters of 2025. Just given the interest payment schedules on those, we had no cash interest payments in 25. So there's going to be a meaningful step up in the cash interest expense in 26 to the tune of $90 million.
They expect to pay interest of $90 million on a quarterly basis? I'm not sure I'm following quite well here. Is it an incremental $90 million? Yeah, meaningful step of $90 million. So they expect on an annual basis to pay $90 million more, from $200 million to roughly $300 million. Okay.
And so that creates some noise in that period-to-period comparison. And then the last thing I would highlight, and you see this in the capex guidance, is we are building out a new London office space. As you know, London is one of our key offices, one of our bigger offices. We are moving locations there, and we'll have meaningful capex around that build out, which will amount to about $25 million of occupancy capex.
This is good. So they mentioned $25 million of capex because they are moving offices and improving their facilities, their offices. If you don't include this, the guidance was what, $160 million? If you remove this, you have $135 million. So the capex is not increasing that much actually.
Beyond that, we are, and I alluded to this, we are continuing to invest in software solutions. Henry touched on this, notable investments into custom index and basket builder capabilities, which we're very excited about. Many of the PTS capabilities that I just alluded to. And so that also is adding to the capex. But those three items are leading to, some comparison noise when you look at 25 versus 26. But if you look at top line and cash collections, continues to be very healthy. And we continue to believe there's a strong trajectory of free cash flow growth going forward here, particularly free cash flow per share.
Of course. Okay, let me just show you the capex over time. Capex and intangibles. This is this one. So they said it was going to be $160 million, but you have to remove $25 million because of this. So the capex is expected to grow a little bit. Mostly software. Okay.
Thank you. And our next question comes from the line of Alexander Hess from JP Morgan. Your question, please.
Hi, everybody. First of all, Bear, congratulations on your retirement, and congratulations again. Want to maybe ask about the reiteration of the medium-term targets and then some comments, Andy, that you said that about the strength of the pipeline. Can you give us a little bit more color on how you break down that pipeline strength into sort of a cyclical uplift, the mega trends that have been discussed on the call, versus new product innovation? I know that you called out a sort of a number that was last quarter on the new sales. But just sort of any color on what's driving that pipeline would be really helpful, and how that might convert into the low double-digit target.
Sure. Yeah. So as I mentioned, we're definitely encouraged by the pipeline. Henry alluded to this earlier, but there is an environmental dynamic here. On the margin, I think we've seen constructive buying behavior across many client segments. On the margin, we've seen a good degree of confidence on a number of fronts. I think the sustained favorable market momentum is something that does feed into that confidence. And as we mentioned, we saw pretty good results and some improvement in sales and growth with asset managers, which is an area where, we continue to see the secular pressures, and we'll continue to see some of those secular dynamics at play. But we've seen on the margin a slightly healthier environment across asset managers. But I would highlight, most importantly, as you alluded to, a lot of the momentum we see in the pipeline opportunities are related to the actions that we are taking. And so it does relate to the innovations that we are releasing across the company, our enhancements to client service, go-to-market, our orientation around client segments. I think on all those fronts, we're opening opportunities up in many of these new big client segments, as well as within our existing well-established client segment areas. So we're seeing decent momentum on both fronts here. Just to specifically hit your question about new product contribution to sales. We saw in 2025 roughly a 20% increase in the contribution to recurring sales from recently introduced products. We continue to see a strong and building pipeline of opportunities related to those new products, and those cut across almost every part of the company. But it's something that is definitely creating pipeline opportunities for us.
Yeah, nothing is
we're
changing.
Definitely excited.
Our next question comes from the line of Kelsey Zhu from Autonomous. Your question, please.
Hi, good morning. Thanks for taking my question. On ESG, I guess a while ago, we talked about the regulatory headwinds or regulatory uncertainty in Europe and how that's impacted growth.
Yes.
What are you seeing in that market more recently, and when should we expect ESG to recover in Europe?
Good question.
Thanks a lot.
So the recovery in Europe is already taking place. There's no doubt about that. Not at the pace that we would wish it would be happening, but it's already taking place. Obviously, it's in the context of a new reality that not everything, in terms of performance and portfolio construction needs to be ESG when the pendulum swung too far on that side. The big focus is on financial materiality in people's portfolios. And we're also benefiting from a consolidation of suppliers of ESG data and ratings and analytics into the European market. We alluded to this in the prepared remarks, that one of the important sales that took place in sustainability was this wealth technology platform in which we become the supplier of choice, compared to others, and they've eliminated that other supply. So there is a benefit that we're getting from that. I think so. I'm hopeful, and the pipeline indicates that we will continue to grow at a decent clip in sustainability in Europe. I don't think we have reached bottom yet in the Americas market, in the U.S. market, not in Canada, but in the U.S., given some of the political sort of undertones in the various states and all of that. So that will continue to be soft. I think we're holding our own and we're consolidating. We're being very aggressive in displacing others in the marketplace, et cetera. But that is going to remain a pretty significant battleground on that. And in APAC, the business never took off totally, and it kind of slowed down a little bit, given all the issues around the world. But we've been putting in place new management, new salespeople, new dialogue and penetration, and I think that it will be a meaningful, maybe not a strong contributor to our sustainability sales. Now, more importantly than all of this, I would say strategically, is one of the things that it completely dawned on us was that the onset of the ESG revolution, so to speak, was just the early days of understanding emerging non-traditional risks and opportunities in the analysis of securities and in the build-out of portfolios. So as time goes by, we will be using a lot of our expertise and our data and our client relationships to expand the ESG/sustainability franchise into analyzing the effect of other risks in portfolios, and those are obviously tariffs. We have enough data and capabilities to analyze where companies are producing goods and services, right, and where they're selling them. Supply chain, the effect of AI on companies. We have enough data and are getting much more to analyze the effect of AI. Is it a good thing for a company? Is it a bad thing for a company? And the like. So obviously, climate will be the mother of all emerging risks in clients' portfolios. We will be doing that, especially on a physical risk basis. We're really pivoting significantly from not just transition risk, but to a physical risk, which is where the big demand is today, and especially with shorter-term pools of capital like banks and insurance companies, in addition to the longer-term pools of capital. So we're very excited about this area of our business. It is going through a transformation for sure. It has slowed down, but we're hopeful that with all the comments that I made, plus the pivoting towards other forms of emerging risk, given the franchise that we have and the expertise, that this will be a long-term grower for us.
Our next question comes from the line of Craig from Huber Research Partners. Your question, please.
Great, thank you. Bear, all the best to you going forward. I thought you did a great job. Andy, on the cost side of things, a couple quick questions here for you. As you know, the last 4 years, so 2021 to 24, your analytics costs were flat, give or take. And in the last 2 quarters, back half of last year, they're up 11 to 12%. Can you just give us a little more understanding about what you guys are investing in there in the analytics area, and what should we expect there in 2026? And then my nitpick question on the sustainability and climate side of things, your costs there in the fourth quarter, I guess, were down about 6% year over year. Was that just some true-up maybe you did on the bonus accruals, or what happened there? I want to understand that, also going forward for sustainability.
Wonderful. This is the kind of questions I love to see. They said 1 year ago that costs would go down and margins would go up for analytics. But for the past couple of quarters, it turned out costs are going up, margins are going down. So what is happening? Is this normal? Should we worry about it? It's a very good question.
Thank you.
Sure. Yeah, so Craig, on the analytics side, we can get some natural lumpiness, both on the revenue side and on the expense side, and the expenditure side more generally in analytics. Things that will impact EBITDA expenses, but overall operating expenses as well, are things like the level of capitalization that we see in any given period. Expenses like severance, and that's something where we did see some variance, particularly in the fourth quarter, can cause some swings in period-to-period comparisons. FX is one that you've probably seen in the past. We do have some meaningful exposure to non-USD employee expenditures on the analytics side. So FX, especially when you see a depreciating dollar, can lead to some expense pressure there. And so a lot of it is just kind of the traditional drivers of lumpiness that we will see. There have been some elevated expenses related to infrastructure investments that we've been making. Again, I wouldn't focus too much on that, but that has been a piece that stepped up. We are, as Henry alluded to, making a number of enhancements around our AI insights. Many of the capabilities that he alluded to in terms of being able to dynamically build baskets, look at signals, investment signals on a real-time basis. We've got some very cool projects going on, and continue to build out capabilities in other frontiers across our equity analytics and multi-asset class analytics. So wouldn't focus too much there. And as you know, we don't necessarily solve for or driving for specific margin or even expense growth rates in any specific segment, but continue to allocate just based on where we see the attractive investment opportunities. On the sustainability and climate front, listen, I would say along those same lines, we always manage our expenditures dynamically, and we are proactively allocating based on the opportunities we see and market dynamics. We are continually reallocating to those areas that we think generate the fastest payback and have the highest return. We continue to invest in definitely key areas in sustainability and climate. Henry touched on a number of those areas that we are focused on. But on the margin, there are areas where we're investing less. And so on the full year, you did see roughly flat. I think it was 2% expense growth, as you alluded to in the fourth quarter, down 6%. So there is some noise around other expenses that can be lumpy, but you can see we are generally growing expenses less in sustainability and climate.
Okay, so basically temporary problems, temporary cost, foreign exchanges change, nothing really dramatic. The strategy and the guidance of the management have not changed.
Our next question comes from the line of Owen Lau from Clear Street. Your question, please.
Good morning. Thank you for taking my question. For private asset, you highlighted a number of opportunities there. One of the key themes in this space is tokenization. How does this tokenization trend impact your world, or you don't see much of an impact at this point? Thank you.
Sure. Yeah, so I think it is potentially a big catalyst for us on a number of fronts. I'd say it hasn't been significant to this point. I think it can have a significant impact on markets and financial products, number of areas that we are focused on and see big potential. But your question specifically around private assets, listen, we know there is, and this is why we are investing in space and seeing tremendous opportunities. Investors are getting deeper into what is in their portfolios, understanding their risk, what's driving returns, what's the value that managers are providing, how to think about, I'd say, more of a traditional asset allocation across private assets. And so you see a tendency, especially with more open-ended type vehicle structures and continuation funds, that people are more dynamic in how they invest their money across private assets. And it is a cumbersome process today. I think as many of you appreciate, we have seen tremendous growth in the secondary markets there, both secondary funds, but also secondary transactions of LP interest. As the world moves towards tokenization and really streamlines ownership transitions, sales and purchases of private assets, it's going to necessitate the need for things that we are investing in, like evaluated prices, like credit risk, like portfolio tools. And so we think tokenization could be a big accelerant for not only the private markets generally, but the tools that we offer.
Our next question comes from the line of Scott Ritzel from Wolfe Research. Your question, please.
Hey, good morning, guys. Just wanted to go back to some of the remarks you made on the active asset manager end market. I mean, it sounds like there's been a little bit of a shift in tone towards kind of more positive outlook on that end market. So just wondering if you can kind of share a little bit more color on some of the trends you're seeing there and what's driving maybe a little bit more positive sentiment on the outlook there. Thanks.
Yeah, so clearly active asset management in a world of high concentration in indices, especially the super scalers in technology, have had a tough time, performing relative to indices around the world. So we have seen continued outflows, cost pressures, and the like. So what we have done throughout 25 is evaluate which is the best way that we can help this industry. They need us badly in order to return to high growth and profitability. And so I alluded to the move of active portfolios to an ETF wrapper, and the MSCI can play a very large role in doing that. Secondly, is to help a lot of the clients create investment products so that we are gradually turning MSCI from a cost center inside many of these managers to trying to be a profit center, a revenue producing center, a new product development center. Now, not every manager will want us to be as proactive, but we are offering that opportunity to people in that. We are also helping clients consolidate suppliers into us. We're an extremely reliable, dependable supplier. Many of these active managers have a dozen index suppliers, a dozen analytic suppliers, and all of that, and they can easily consolidate to us. So that's another initiative that we have, and therefore displacing competitors in that area. So it's a gradual process, but the important part, and I think what you're seeing in the results, is that we took a meaningful part of the first half of 25 to say we need to change the way we approach this segment. We cannot continue to be just one more cost pressure on them, and that's bearing a lot of fruits. And the journey is still early, and we believe that we can return to higher growth with them.
So 7% growth can rebound to 8% growth to 9% growth. Okay, that's bullish.
Thank you. And our next question comes from the line of Faiza with our next question.
Yes, hi, thank you so much. I wanted to ask about the AI efficiencies that you referenced earlier in the call and have referenced previously. So sorry for the two-parter, but one, I'm curious if you're able to potentially quantify some of the benefits from the efficiencies that you're expecting this year and how much incrementally you're able to reinvest in the business. And then I guess longer term, I know you haven't changed sort of your longer term outlook around profitability, but I'm curious if at some point, this can result in better profitability over time, or do you think there's just going to be, continued reinvestment, whether it's in the form of new products or potentially, some pricing give back to your clients?
Yeah.
So it's definitely a question that necessitates maybe a long answer, but we're going to try to be as brief as possible. We can follow up with you on offline. The first thing strategically to recognize is AI is a godsend to us in two directions. The first direction, very importantly, is that through the application of AI, we can lower the run rate of expenses in our existing business. And in doing so, we can then take those savings and put them back into the run rate of investments in what we call the change the business, the new innovation, the new areas. We have enormous opportunities at MSCI, and we are severely handicapped in persecuting all those opportunities by the size of our investment dollars. And we have been extremely disciplined not to take the money out of the profitability of the company. It has to come from the reallocation of cost in the company. So that is something that is beginning to play into the expenses of the company in 2026. It started a little bit in 25, but it's going to play in 26, going to accelerate in 27, and then accelerate further in 28 to the point in which we can grow the rate of growth of our organic investments in the company at a much higher pace, probably double the pace that we've been growing so far. So that is a significant opportunity for us. The second one is AI.
So they are clearly telling the world margins are going to increase in 2026, 2027, 2028. Wow, that's big.
The second one is AI is going to help us accelerate significantly the pace of product introduction. So because, for example, we've been able to, through AI and the application of AI, to gather much more data and more granular data in private assets. And that has allowed us to create terms and conditions of credit and private credit, been able to help us analyze the holdings of funds so we can create eventually holdings-based private assets indices and things like that. So that's going to accelerate us quite a lot. And since we've never been a big workflow software applications company, AI also will help us accelerate the ability of people to use our content. We have something called at MSCI, how do our clients consume our content? We do analysis of every product line like that. And through AI, our clients will be able to consume our content much easily, much broadly than through sort of, inflexible sort of workflow applications and the like. So those are a few examples of that. Why don't we take it offline so we can, our team can tell you more about the quantification of all of this.
That's strange. He doesn't want to share the numbers officially. He wants to speak about it offline. Maybe they don't have the numbers. Maybe they don't want to share this with the world for several reasons. Interesting, they don't want to mention the numbers online.
Our next question comes from the line of George Tung from Goldman Sachs. Your question, please.
Hi, everyone. This is Anna Wu for George Tung. I wanted to start by extending our congratulations and best wishes to Bear. My question is on cancellations. Can you give us some color on conditions you believe that need to occur before we might see a sustained reduction in cancellations, and how do you see those underlying dynamics across segments? Thank you.
Yeah, maybe an overarching comment here, and I alluded to this earlier. We are seeing some improvement in overall client dynamics on the margin. Generally, it's relatively consistent, but on the margin, in areas like asset managers, even in places like EMEA, we are seeing some improving dynamics. So that's helpful. I would say the areas where we see lower retention rates are in, and you've seen a slightly lower retention rate in sustainability and climate. I think Henry alluded to some of the pressures that we're seeing in the Americas on the sustainability and climate front. And then in real assets, we've seen a slightly lower retention rate, although it has been lumpy and has improved in spots. And as I alluded to, we are seeing some encouraging trends on the real asset front. Outside of that, we I think are seeing pretty good engagement from clients. We're seeing overall health improving, and I think a key component of driving the higher retention rates beyond just the environment are the things that we are doing. So enhancements to client service, which are resulting in enhanced client satisfaction, improvements in the products that we're releasing and the innovations we talked about, many of which are to facilitate and support price increases.
Here we go. First comment about price increases. So we're resulting in enhanced client satisfaction, innovation, because of the innovations we have talked about, many of which are here to facilitate and support price increases. So they plan to have price increases in the future, but they don't know when. Okay.
And so I'd say we'll continue to see some of the pressures in those same areas. I've mentioned this in the past on the sustainability and climate front, on the real asset front. Some lingering pressures in parts of the asset management market, but overall, I'd say we've got good momentum and we're doing the right things to drive strong engagement and retention.
Thank you. And our next question comes from the line of David Motemaden from Evercore ISI. Your question, please.
Hey, thanks. Good morning. Thanks for squeezing me in here. Andy, in the past, you had mentioned some potentially elevated cancels for asset managers in Europe. I'm wondering if that played any impact on the retention levels this quarter and how you're thinking about that in 2026.
Yeah, it's building off the last question of my response there. Yeah, it has been one of the dynamics that we've seen for the last couple of years, actually. We've seen a slightly lower retention rate in EMEA. Just to mention that, I think we saw a retention rate slightly below 93% in EMEA in Q4 versus a retention rate slightly above 94% in the Americas in Q4. It does bounce around quarter to quarter, but generally we've seen a higher retention rate in the Americas for the last couple of years, and I think that is a reflection of those dynamics that I've alluded to in the past around some of the pressures on asset managers there, some of the M&A transactions that have occurred. I'd say we're not expecting any pickup in the future. As I alluded to, if anything, we're seeing some improvement in client dynamics on the margin. But I would say we're generally seeing a fairly consistent dynamic on the EMEA front. And that lower retention rate actually, we see it across product lines other than S&C. So sustainability and climate does have a higher retention rate in EMEA versus the Americas, but outside of that, we see a slightly lower retention rate in EMEA versus the Americas. So I'd say no notable change in dynamics, if anything, slight improvement on that front.
Okay.
Our next question comes from the line of Jason Haas from Wells Fargo. Your question, please.
Hey, good afternoon, and thanks for taking my question. I'm curious if you could help reiterate what's driving the strength in index recurring subscription revenue outside of asset managers. Is there any way to help stack rank what those drivers are and just your level of confidence in those continuing? Thank you.
Sure. Yeah, it is multifaceted, but at the highest level, we are seeing a move in the investment industry, and this is one of the most powerful trends impacting the investment industry, is a move towards personalization, customization, customized outcomes, custom portfolios. And an index is a very efficient and effective mechanism to reflect a specific investment view, investment objective, or a strategy that an investment industry participant has. And so that is underlying the opportunities we see across the new products we're releasing, existing products that we have, as well as the client segments that we're going after. Maybe to tackle your question along client segment lines, our highest growth client segment has been, and in the fourth quarter, was hedge funds. You've heard us talk a lot about the trading ecosystem and opportunity with hedge funds, broker-dealers, trading firms. That growth is being fueled by their thirst for content. That's content to help them better understand markets better understand our indexes. They are increasingly looking for more content sets that we're actively releasing that ultimately help them navigate the markets and capitalize on opportunities more effectively. And so we saw 19% growth with hedge funds. In the fourth quarter, we saw 10% growth with broker-dealers, and related to that, we see broker-dealers developing things like over-the-counter derivatives, index-linked swaps, structured products as tools to help their clients, whether those are institutions or even high-net-worth individuals, achieve specific investment objectives and risk and return and exposure objectives across their portfolio. And then, even on asset managers and asset owners, when you look at the growth we've seen there, the growth is, I think, 8% on both asset managers and asset owners and index.
Okay.
licensing more content from us across more parts of their organization and more use cases. And they are just finding more utility in the breadth of content and tools that we are providing on the index front that enable them to achieve their specific objectives via index portfolios. And so I'd say broadly, it's being fueled by this need and demand for custom outcomes. We're feeding that with our existing index IP, but also more and more custom indexes. Henry alluded to some of the new capabilities that we are releasing now and on the verge of releasing over the coming quarters, things like our basket builder, advancements on the custom index front that allow clients to actually directly interact with and backtest portfolios and build their outcomes. We think that's going to unlock massive opportunities. So listen, in the near term, we're fueling the growth.
I'm not really happy with this answer, to be honest. Frankly, that's a lot of words to say clients like custom indexes. We see demand for custom indexes, so we are bullish for custom indexes. That's it. So many words for custom IPs, etc. I'm not a fan of the complex answers they are giving.
You're seeing nice growth, and we have been for several years with the trading ecosystem buying more content, but we're seeing elevated growth and enhancing opportunities across all parts of the investment ecosystem to use our index content. So I'd say it's a very compelling opportunity and part of the reason we remain so bullish and excited about the future.
Thank you. And our final question for today.
Final question.
Alex Grant from UBS. Your question, please.
Hello again. Sounded like you wanted some follow-ups, so here it is. No, this is a quick one, and it's actually a follow-up to my earlier question. I think Henry suggested that you are having a little bit more pricing power as the environment has gotten better. So maybe for you, Andy, any more meat you can put around this? I think in the past you've talked about contribution from pricing, etc. So maybe a little bit more in terms of 2026. What are you expecting across the different segments?
Great question. Historically speaking, the revenue growth rate was contributed by pricing or more volume. 30% of the revenue was coming from price increases. 30% of the revenue increase is coming for 30%. And then in 2023, customers revolted. They were not really happy with the price increases. So MSCI slowed down on price increases since 2023. But since then, the company has invested a lot in their ecosystem to deliver better services. 2023, 2024, 2025. So when do you start increasing your prices again? Good question.
Thanks.
Yeah, I would say generally the contribution from price increase has been relatively stable. There are puts and takes across the business based on innovations, enhancements we make to existing services, client health and usage of our tools. And as I've alluded to before, there are certain areas where Henry talked about it in areas like S&C where the health does vary in different geographies. But overall, we've seen a relatively stable contribution from price increases.
Not true.
As you're asking about, and I think I alluded to this back in December, and we've mentioned before, the enhancements we are making on many fronts, we are monetizing through price increases. And so that's something that's not only supporting upsales, but price increases. So I would say there's some nice sustainability and durability to our ability to continue to increase price because we are significantly enhancing the value that our clients get from our tools. And this is an area where AI is particularly exciting, where it's allowing our clients to do more with the services we provide and be more efficient in how they operate. And those should allow us to continue to unlock commercial value through price increases over time.
He did not answer the question. We wanted a number. We wanted a timeline. Are you like Microsoft and you plan to increase by X percentage in these months? No, he just said, we will continue to increase our prices. I don't like this answer.
Yeah.
Thank you. And I'd now like to hand the program back to Henry Fernandez, Chairman and CEO, for any further remarks.
So thank you, everyone, for joining us today. As we have described this morning, MSCI's all-weather franchise helped us complete another strong year of underlying business performance and attractive margins. We are also building momentum in the company in terms of creatively and aggressively selling across all client segments what we currently have. And the new product machine and the new innovation mode of MSCI is getting into high gear. And that will help us continue the momentum that we have generated in the last 2 quarters. It feels like we kind of bottom out in the second quarter of last year. Obviously, too early to tell at this point, but we feel pretty confident and pretty encouraged by the pace of innovation, the pace of selling, the dialogue with clients, the market drop, and for sure, the level of innovation and product launches that we are achieving. I'd like to take this opportunity one more time to thank my longtime friend and business partner, Bear. MSCI would not be what it is today without Bear, your contributions, your leadership, your dedication, your owner-operator mentality. We wish you great happiness and fulfillment and good health in your retirement. And we for sure will be taking care of your retirement dollars here and make them multiply. So with that, again, I'd like to thank everyone.
And thank you, Henry, for your partnership and incredible leadership, which I'm very confident will continue.
Thank you. Thank you all.
Okay, wonderful. So we learned a lot of things with this earnings call. It was a long earnings call. I don't know how long my video will be, but yeah, pretty long earnings call. We learned some new things about the pricing, about AI, efficiency, different regions, and as I told you at the beginning of the video, this report was a mixed bag, mixed report. I'm quite surprised the stock is up so much. Yes, the management is bullish on the call and some segments are bottoming, like active asset owners, but some other segments are deteriorating with some cost pressures in the analytics segments. So a mixed bag. I hope the video was helpful to you. You now know all the positives and all the negatives of this report. I hope this video was helpful to you. Leave a like, comment, subscribe, and I see you tomorrow for another video. Bye bye everybody. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a video, a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.